You've heard founders often say, we have raised funding on safe instrument. If you're new to startup, that sounds like jargon, right? So let's break it down into what is a safe instrument, why was it created, when startups use it, and what does it actually say? Now, let's go a few steps back. What's the problem? The problem is, remember from my previous video, the challenge is that startups need money early on. Now, to raise this money through a full equity round that early in their life is very difficult. What does a full equity round actually mean? A full equity round means when investors fund a startup, they expect to be given an ownership percentage in that company right away. The problem with a full equity round is that for that to happen, you need to agree on a valuation, you have to negotiate how much of the company ownership they get, you have to issue stocks, there's a lot of paperwork and a lot of lawyers' fees, and it takes time. And at that stage of your life cycle, that's exactly not practical when you're just getting started. At that stage, you basically just need money, not all the hassle that comes along with it. So to overcome this, founders used to raise money with something they called a convertible note. Basically, it says that I'm investing in a startup now, and the investment turns into shares at a later date. Sounds better, right? But here's a little problem, that these convertible notes came with an interest, deadlines, and in theory, investors could ask you to repay against the convertible note. Imagine being a tiny startup and somebody says, hey, I want my money back. Yeah, that's not fun. But here's where safes come in now. In 2013, Y Combinator, which is a startup incubator, you can say it's like a startup school where a lot of startups are incubated. And it's behind big companies like Airbnb, Dropbox, Stripe, and a lot more. Anyhow, Y Combinator said that we need something simpler. So they created this thing called a safe instrument, which stands for Simple Agreement for Future Equity. It's not debt. It's not equity yet, it's just a written promise where a startup says to the investor that you give me your money today, don't ask me about the valuation, don't ask me about how much percentage you own in my company, I'll give you the shares later when I raise a proper equity round, say Series A. So you'll get to know the percentage of how much you own in my company later. It has no interest, no deadlines, clean, fast, done. Safes are most common at the pre-seed and seed stages, which are the very, very early stages, because at that time, remember you're raising money from angel investor, friends and family, so they are quite small check sizes and they are happy to write a safe for you. Think of it as a quick way to raise money before you're ready for a big round like Series A. Now that we've understood what are safes, let's take a few steps deeper and try to understand what does it say, what is contained inside different clauses of a safe agreement. Clauses around valuation caps, it may contain clauses around valuation discounts, MFN, which is most favored nation, and it could talk about pro-rata rights amongst a lot of other things. To understand these clauses, let's work out a simple example. Say you are an angel investor who's giving $100,000 to an early stage startup on a safe note. Because you are endorsing this early stage startup and you're taking a risk in that, what you might do is you will agree on a valuation cap. Okay, let's understand with a worked example. You've invested $100,000 into this company today, and a few months later, let's say 6 to 8 months later, when the company does a Series A round, at that time the company is valued at say $40 million. As part of your safe agreement, you had already agreed to a valuation cap of $20 million. So the company value is 40, but you agreed that I'm going to convert my safe at a $20 million valuation. Now, how does that play out actually in numbers? Without a valuation cap, your $100,000 investment would have been divided by $40 million of current valuation to give you 0.25% of ownership. With this $20 million valuation cap that you have now agreed, or rather agreed at the time of safe, your $100,000 of investment would be divided by $20 million of valuation to give you a 0.5% of ownership. It's the same money that you invested, the $100,000, but your ownership is not 0.25, it's 0.5, double the ownership. So basically, a valuation cap sets the maximum price at which your investment turns into your share ownership. In a way, it is to reward the early investor for the risk that it had taken in your business early on. In a funny way, it's like locking in a pizza at $10 before it went into the oven, and later when it came out with the fresh aroma of cheese, the price jumps to 30, but you still pay 10. Moving on to valuation discounts. It's a similar concept, slightly nuanced. Suppose you agreed to a 20% valuation discount as part of your safe agreement. This simply means that you get shares cheaper than the new investors in the next round. Let's do a worked example. Using the same example, say you have invested $100,000 in a startup on a safe note. The Series A valuation comes out to $40 million, but you had agreed to a 20% valuation discount. So for you, the valuation is not 40, it is 32 million, which is the 20% shaved off from 40 million. Without a discount, your ownership in this company would have been your same $100,000 invested divided by 40 million valuation to give you 0.25% of ownership. With this discount that you have now negotiated, your 100,000 will be divided by 32 million, which is a discounted valuation to give you a 0.3% ownership. So the analogy is like you are buying, say, an early bird concert ticket. Everyone else pays 100, but you pay 80. So understand it like this, for example. The next important clause for us to discuss is the MFN clause, which is the most favored nation clause. Assume there are several safe investors. So this startup has raised not just one safe note from me, but from you and the other person watching and the person behind there. So there are like multiple safe notes and there are multiple safe investors. MFN clause in your safe agreement would mean that if later stage safe investors get a better deal, that your deal would automatically upgrade to their. For example, you invested early into the startup with your $100,000, the same example. You didn't agree on a valuation cap, you didn't agree on a valuation discount, and you just gave the money. Later on, somebody gets a 20 million valuation cap, another safe investor. Without MFN, without this clause, you're stuck at your 0.25% of ownership. Remember, $100,000 divided by 40 million valuation? But with an MFN, without having agreed a valuation cap in your safe agreement, you upgrade to the 20 million cap, which means that your ownership is now going to be 0.5%. How? Your 100,000 invested divided by 20 million. Not because you agreed to that valuation cap, but because somebody after you agreed on that, and this MFN clause basically upgraded you to the same terms as they got. So it keeps things fair between all the safe investors. In a real life example, you could try to understand it like it's a store price match guarantee, where the store says, if somebody else get a better deal, you get it too. There's another important thing to understand, which is called the pro-rata right. In a simple way to understand it is to say that pro-rata rights let you put in more money later in the round so that your ownership percentage doesn't shrink. It just gives you the right, not the obligation, to put in more money at a later stage to maintain it. Let's do a worked example. So say you gave money, same $100,000 to a startup, and 8 months down the line, the startup raised a Series A round, and your shares, your safe basically converted into equity, and let's suppose it gave you 2% of the company. Without pro-rata rights, as more investors join in Series A, your slice shrinks to maybe 1.5%, maybe 1% and even less. But with pro-rata rights, you can top up in the new round and stay at 2%. That way you keep your seat at the table. A good way to understand is, imagine a pizza with 8 slices. You own 2 of those slices. Then the pizza size doubles to 16. Without pro-rata right, your share looks like tiny because it's 2 slices on 16 slices. But with a pro-rata right, you are given the option to buy 2 more additional slices so that now you have 4 out of 16, so that you keep the same proportion. Why founders like SAFE? First of all, SAFEs are quick and cheap to set up. There is no interest, no maturity dates like we saw in convertible notes. At the same time, it's a great way to raise small checks along the way. There's one catch though. If founders issue too many safes, let's say hundreds of safes, and they don't track them properly, when all of those safes convert at the next equity round, they can be shocked at how much of ownership they have lost. So while safes are simple, but they need to be managed with discipline. In the next video, I'm going to take you through what are cap tables and what do they exactly contain. So hang on.